Our base case for 2019 is the U.S. economy is going to revert to trend growth. So we don't see a recession coming through later this year or even early next year, because we think U.S. fundamentals actually remain quite solid. The U.S. consumer is in a very healthy place. The Federal Reserve has indicated that they're willing to slow down their pace of tightening. So some of the slowdown we've seen due to financial conditions tightening will be easing off the data. So whilst the fiscal impulse will be fading, we still see a very solid U.S. economy.
So what does this mean for the U.S. dollar?
Ultimately, against developed market currencies, I think what the dollar faces is the fact that it remains one of the highest yielding developed currencies means that it'll be a rather hard sell against G10 currencies. That said, we do also expect to see a pickup in growth in the rest of the world later this year, which will be supportive for currencies in the second half of the year. So strength in the first half and perhaps a bit more of a range-bound environment for the dollar going forward.
Irrespective of the Fed's next move, if the Fed does wait until June, like we just heard from the Fed Boston president, does that still mean the dollar can perform?
I think that's pretty much priced in. When you look at what rate markets are pricing in, we're not expecting a hike this year. At least that's what, when you look at market implied interest rates for the rest of the year, look like. So a pause by the Fed is pretty much the consensus. The risk would be actually if the Fed indicated that they are going to be hiking similar to what we saw last year. So I think the balance of risks as far as the dollar goes are much more balanced.
So if the Fed does hold off for a few more months and we see essentially the idea that emerging markets react to that decision, are they going to react positively in your view?
I think they will. Ultimately, the last year, what we saw was the tightening by the Fed was starting to impact EM currencies. So they were weakening in response to tighter financial conditions in the States. So as that fades out, we do expect to see EM currencies becoming a little bit more robust, and we expect growth to pick up. China as well is easing fiscal stimulus, and we're seeing rate cuts, VAT cuts and RRR cuts coming through from China, which will be supporting growth in China and the rest of the EM space.
And diving into the EM space in terms of the opportunities for 2019, how do you view sovereign debt versus corporate debt in terms of the risk reward here?
So within the EM space, we think it's an interesting dynamic. We like both EM corporate and sovereign debt. We expect default rates to remain quite low in the corporate space. Leverage is well contained, so we don't see a pickup in EM corporate leverage. And the pickup in growth will ultimately benefit these EM corporates. So we like EM corporates, and we think they will continue to perform well. On the sovereign space, ultimately, it's what happens with the dollar. So if we do see a strong repricing in the back end of the US curve, then that will impact total returns from a sovereign side. But we do think actually a pickup in growth should see spreads tighten.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.